Welcome to the Daily Crypto Roundup. Today we're digging into the major stories. First, the United States and China are at it again. Their trade spat shaking markets and sending Bitcoin back under 109,000. Second, regulators have returned to the spotlight, with the G20's Financial Stability Board warning that the world still hasn't built a unified crypto rulebook. And finally, we'll finish on a rare optimistic note. The launch of Erebor Bank, a new crypto-friendly US bank founded by Palmer Luckey, which just earned its first regulatory nod. If you haven't already, follow the show and drop a 5-star rating. It takes 2 seconds, but it makes a massive difference in helping independent crypto coverage cut through the noise. Now let's run through the top 10 coins by market cap, skipping the stablecoins as always because they don't tell the real story. Bitcoin is sitting around $108,755, down about 1.9% over the last 24 hours. Another reminder that the macro tide still rules the ocean. Ethereum trades near $3,936, off roughly 1.2%, steady but heavy after Powell's latest comments cooled sentiment. BNB is holding close to $1,225, down just under 1%. Showing surprising resilience compared to the majors. Solana is back around $203, dipping about 2.4%, as network volume remains strong, but risk appetite fades. XRP trades near $2.50, down roughly 1.5%, caught between lawsuit optimism and broader market fear. Cardano is sitting at 70 cents, off 1.8%, still one of the more stable mid-caps through the turbulence. Dogecoin hovers around 20 cents, down just over 2%, mostly following Bitcoin's lead as meme traders stay quiet. Tron is at 31 cents, slipping 0.7%, while Chainlink holds around $19, down about 1.1%. Finally, Avalanche sits at $22.90, easing just under 1% as developers continue pushing network upgrades. Altogether, it's a sea of red, not a collapse, but a clear reset. Traders are watching and waiting for the next macro spark to bring liquidity back into the market. So what exactly pushed prices lower again? It starts with geopolitics. Overnight, Beijing accused Washington of stoking panic in commodity markets by threatening new tariffs and tightening export rules on rare earth metals, the materials that keep global tech production alive. That accusation landed like a thunderclap on futures markets. Equities dipped, bond yields popped, and within an hour crypto had joined the slide. Risk assets move as one organism when macro turns ugly. At the same time, the G20's Financial Stability Board released its long-awaited assessment of global crypto regulation. It warned of significant gaps in oversight and coordination, saying that inconsistent national rules create arbitrage, opacity, and contagion risk. Coming from the FSB, that's not casual language. That's a warning shot. Analysts like Elena Petrova from Horizon Analytics said the report could mark the moment regulators stop competing for jurisdiction and start collaborating, which in practice means tighter, not looser rules. For markets, that translates into one more layer of caution. Then there's Jerome Powell. Yesterday, the Fed chair addressed the National Association for Business Economics. His remarks were meant to reassure, but they landed awkwardly. He said the U.S. economy is on somewhat firmer footing, yet hiring remains unusually quiet. The key phrase, "there is no risk-free path," sent a ripple through markets. Traders had convinced themselves that rate cuts were coming quickly. Powell reminded them that the central bank moves meeting by meeting. He hinted the Fed might slow its balance sheet runoff, which would be modestly supportive for liquidity, but he refused to signal when. Michael Safai of Dexterity Capital summed it up. Powell giveth, macro taketh away. And Vineta Dimitrova at Bloomberg Macro called it a tug of war between liquidity hope and trade fear. The result is visible on every chart, a market that wants to rally but keeps tripping over global politics. Now, behind those headlines lies structure. Leverage remains the ghost haunting this market. After last week's $19 billion liquidation, many expected traders to stay cautious. Instead, derivatives desks rebuilt long positions almost immediately. Kaiko Analytics reports that open interest across major venues was up 12% by midweek, meaning plenty of dry powder for another flush. When tariff headlines hit, that's exactly what happened. Funding flipped negative, stop-outs triggered, and within hours nearly $2 billion in positions evaporated. Greg Magadini from Amber Data described it as leverage reflexivity. Small catalysts become massive when collateral gets thin. It's a dynamic familiar to veterans of 2021's roller coaster cycle. Once liquidation engines start, human decisions hardly matter. Yet amid the gloom, there are signs of accumulation. On-chain data from Glassnode shows wallets holding at least one full Bitcoin ticked up again this morning. Retail stackers and small institutions appear to be buying the dip quietly, absorbing what panicked leverage dumps. That quiet conviction often marks the floor long before sentiment catches up. Still, today's macro storm was bigger than crypto alone. Treasury yields jumped, the dollar strengthened, and the VIX, Wall Street's fear gauge, nudged toward 20. Every time that happens, algorithmic correlations kick in. Crypto traders who hedge with equities or FX unwind both sides simultaneously, which amplifies moves. As one hedge fund quant put it to Reuters, it's not about belief, it's about portfolio math. Regulators, meanwhile, seized the narrative. In London, the Financial Conduct Authority reiterated its plan to expand the tokenized fund sandbox in 2026, allowing investment vehicles to issue shares directly on blockchains. Analysts view that as a long-term positive, signaling that the path toward regulated tokenization continues despite short-term volatility. As Priya Mehta from Franklin Templeton's Digital Assets Division told CNBC, "You can't stop innovation because of a drawdown. You regulate it into the mainstream." Then came the bright spot everyone needed. Erebor Bank, the brainchild of Palmer Luckey, the engineer behind Oculus 5R, just received preliminary approval from the Office of the Comptroller of the Currency. The bank's model merges traditional lending with crypto collateral services and even extends to financing AI infrastructure. Backers include Peter Thiel and Joe Lonsdale, both early investors in frontier tech. Business Insider reported that Erebor aims to lend against unconventional assets such as crypto holdings and GPU hardware, positioning itself as a financial bridge for a digital economy. Market commentator Noah Levine called it the single most optimistic headline in a bearish week, evidence that regulators aren't shutting doors, they're building new ones. It's a reminder that beneath every sell-off lies construction. Institutions are still preparing for the next wave. Not the next meme cycle, but the infrastructural one. While traders obsess over hourly candles, developers and bankers are quietly stitching crypto into the mainstream. Erebor's approval doesn't just legitimize crypto lending. It sets a precedent for banks that want exposure without the reputational risk of partnering through shadow intermediaries. As macro stress dominates the screen, Jerome Powell's speech remains the hinge. His insistence that the Fed will move cautiously left traders uneasy, but his hint at slowing quantitative tightening injected a subtle optimism. Liquidity matters more to Bitcoin than almost any single policy lever, and a slower QT process means less daily drain from the system. That's why some analysts see this week's dip as the final shakeout before stabilization. Caitlin Long of Custodia Bank told Bloomberg TV, "We're at a weird junction where macro looks scary, but liquidity quietly improves. That's when bottoms sneak up on you." Her comment echoed throughout crypto Twitter today as traders debated whether this slump mirrors the late 2022 flush or something deeper. Meanwhile, global capital flow data shows that institutional inflows into digital asset funds actually rose 3% week over week, led by European managers. CoinShares attributes it to ETF arbitrage, investors buying on discount. It's small, but it's another layer of resilience. Before we go any further, a quick reminder: protect your crypto. Every week we cover stories of exchange hacks, frozen withdrawals, or government seizures. The truth is simple: if you don't hold your keys, you don't own your coins. That's why I use Ledger. It's the safest way to store Bitcoin, Ethereum, and everything else offline. No third-party risk, no panic when markets move. You'll find the Ledger link right at the top of the episode description. Take 2 minutes, grab one, and protect what you've built. Because self-custody isn't optional, it's essential. Back on US soil, attention turned to how exchanges manage risk under this pressure. Coinbase derivatives volumes dipped only marginally, while Binance saw a sharper contraction, likely due to Asian time zone exposure to tariff headlines. Traders noted that spreads widened more on perpetual futures than on spot, reinforcing the idea that leverage, not fundamentals, is driving volatility. The human side of the story is easy to miss. Many of the victims rescued from Chenji's compounds were reportedly unaware that their work was feeding crypto laundering networks. NGOs now call for blockchain companies to fund rehabilitation programs. It's a stark juxtaposition. A technology built for transparency being abused for deception, then reclaimed by transparency itself. The short sellers had their moment. Funding has normalized. The weekend liquidity lull is approaching, and traders are recalibrating rather than panicking. Bitcoin's correction toward 108,000 has flushed leverage without destroying structure. Ethereum's drawdown under 4,000 follows the same rhythm. Pain, reset, calm. And this is where the Erebor Bank story becomes more than a headline. It becomes a symbol. Palmer Luckey's vision for a hybrid bank that holds digital and traditional collateral may prove to be a model others copy. Inside sources told Business Insider that Erebor's beta operations include instant collateral valuation via on-chain proofs and AI-driven lending risk models. Imagine that. A bank where your Bitcoin, Ethereum, or even tokenized GPU contract can serve as live, auditable collateral for a real-world loan. The implications ripple outward. It blurs the line between crypto finance and traditional credit markets. It legitimizes self-custody assets as productive capital rather than speculative chips. And maybe most importantly, it re-energizes the optimism that the last few weeks had drained. When a project like Erebor wins early regulatory approval, it signals that governments see opportunity, not just threat. Analyst Sarah Millman from Galaxy Research put it bluntly on CNBC this morning. Erebor shows the sandbox is expanding, not shrinking. Regulators are learning to coexist with crypto instead of fighting it. That coexistence narrative could become the counterweight to the fear cycle dominating headlines. Meanwhile, the global picture keeps morphing. In Asia, reports suggest that Singapore and Hong Kong regulators plan joint research on cross-border stablecoin settlements. In Europe, tokenized bond pilots by Société Générale and the European Investment Bank keep scaling quietly. These developments may not move prices immediately, but they anchor the long-term legitimacy that every drawdown tests. An opportunity is exactly what many analysts now see. Bloomberg Intelligence's Mike McGlone said, "We're replaying the same tape from 2016 and 2019. Macro scare, liquidation, then structural climb." Bitcoin's volatility always compresses before expansion. If he's right, this consolidation could be the foundation for the next leg higher once the policy uncertainty fades. The paradox of crypto is that every scare refines it. The Cambodia case showed that transparency is real. The FSB warning exposed the need for uniform oversight. Erebor's approval proved cooperation is possible. And Powell's caution reminded everyone that liquidity, not hype, is the lifeblood of valuation. Together, those threads form the real story. A market shaking off adolescence and inching toward adulthood. Still, traders live in the present, not in philosophy. Short term, eyes are on the 105,000 support for Bitcoin and the 3,800 line for Ethereum. Those are psychological thresholds. Break them cleanly, and we revisit 95K territory. Hold them, and we trigger another round of short covering. Volatility remains the tax you pay for outsized returns. So where does that leave us today? Probably exactly where we need to be, tired, skeptical, but still here. Bitcoin just shy of 109,000, Ethereum holding near. Markets digesting macro, regulators talking frameworks, innovators building rails. The noise fades, the signal strengthens. Crypto's not dying, it's maturing in real time. Every storm leaves stronger foundations. So stay curious, stay disciplined, and remember, markets move fast, but conviction compounds faster. This has been your Daily Crypto Roundup. Drop a 5-star rating if you haven't yet, Share this with someone who trades the headlines instead of the truth, and we'll be back tomorrow with the next chapter. Until then, we'll see you at the top.